Good morning. The mortgage lock-in effect is fading, and that changes everything. But for nearly 3 years, the U.S. housing market has been frozen by one powerful force, the mortgage lock-in effect. And millions of homeowners with ultra-low pandemic-era mortgage rates simply refused to move, which was choking off inventory and keeping prices elevated despite higher interest rates. Now, that dynamic is now beginning to change, and for the better, I hope. According to the recent reporting by the Washington Post, for the first time since 2022, more homeowners now hold mortgage rates above 6% than below 3%. And this shift materially reduces the financial penalty of selling a home and signals a gradual thaw in the U.S. housing supply. And why the lock-in effect matters so much. Well, during 2020 to 2021, millions of homeowners locked in fixed mortgage rates below 3%. And when rates surged in 22 to 2024, selling became prohibitively expensive. So a homeowner was trading a 2.75 rate for a 6.5-7% loan, often faced 40 to 60% higher monthly payments. Nobody really likes that. But even buyers with strong equity hesitated to reset their debt at higher rates. So inventory stalled, especially in move-up and downsizing segments. And this wasn't about affordability alone. It was about rate psychology. So what's changed from 2025 to 2026? Well, the mortgage rate landscape looks very different today than at the beginning of 25. And as Redfin notes, while rates below 5% still discourage mobility, the growing share of homeowners already carrying 5.75 to 7% loans makes selling far less painful than before. So in short, few owners are giving up golden handcuff rates, and more households are rate neutral when moving. And the life events happens, job changes, family needs, downsizing, they're all regaining priority. And that shift matters. And you look at the data right now, and it confirms a slow supply rebound. Housing market data from the National Association of Realtors, published by the Federal Reserve Bank of St. Louis, show a modest but meaningful pickup in existing home sales in mid to late 2025 after years of stagnation. And at the same time, home appreciation, their prices, has slowed. And sellers are becoming more flexible. But days on the market are also stabilizing in many regions. So this is not a housing crash, but it was just a normalization. So what this means for buyers. Well, for buyers, the fading lock-in effect creates opportunity. And more listings means better selection, and less competition reduces bidding wars. And negotiation power improves, especially on move-in ready homes. But for borrowers, this is where strategy matters. Rate buydowns, ARM structures, and future refinance planning are increasingly important tools, not afterthoughts. So what this means for sellers. Sellers no longer have the luxury of assuming instant demand. Pricing correctly, understanding buyer financing constraints, and working with mortgage professionals early in the process will be critical in 2026. And the market is shifting from scarcity-driven to execution-driven. So here's the bottom line. The mortgage lock-in effect hasn't disappeared, but it's weakening. And as higher rate borrowers replace ultra-low rate holders, housing mobility improves, inventory is going to rise, and transactions resume. So for buyers, sellers, and investors alike, 2026 will reward preparation and not hesitation. And if you want to understand how to navigate this transition with the right loan strategy, this is exactly what we cover on our channel. Thanks for watching. Please visit rapponline.com to get a hold of me. Happy to chat about whatever scenario you may have. Have a good day.